How often do you think about your heart health? Are you aware of the risks of cardiovascular disease? Well, let's dive into the heart of the matter. Cardiovascular diseases, encompassing coronary heart disease and stroke, claim the top spot as the leading cause of death in the United States. Particularly at risk are Blacks and Hispanics in underserved communities. It's a sobering reality, isn't it? But there's good news. Cardiovascular disease is largely preventable. Stay tuned to learn how you can keep your heart beating strong. Heart Smarts, a health program, is here to empower you to live a heart-healthy lifestyle. This program is not just about information, but about transformation. It offers a comprehensive approach to help you understand and achieve heart health. Heart Smarts is committed to reducing the incidence of cardiovascular disease, the leading cause of death in the United States. The program focuses on underserved communities where the risk of heart disease and stroke is greatest. Through education and empowerment, Heart Smarts aims to turn the tide on these statistics. It's a call to action, a call to change, a call to live healthier, longer lives. Heart Smarts is about arming you with the knowledge and tools you need to make heart-smart choices every day. It's about the power of prevention and the promise of a healthier future. Remember, Heart Smarts is not just a program, it's a life-changing journey. It's about taking control of your health, one heartbeat at a time. But don't just take our word for it. Listen to these stories from people who have benefited from Heart Smarts. Imagine being told you're at risk for heart disease, a leading cause of death in the United States. Now picture having the knowledge and tools to combat that risk head-on. For people like Maria, a single mother from an underserved community, Heart Smarts was a beacon of hope. The program informed decisions about her heart health, ultimately reducing her risk of cardiovascular diseases. And then there's John, a middle-aged man who was once a prisoner of his poor lifestyle choices. For him, Heart Smarts was not just a program, but a lifesaver. It opened his eyes to the risks he was taking and gave him the push he needed to commit to a healthier lifestyle. These are not just testimonials, they are life-changing stories. Stories of empowerment, resilience, and triumph over heart disease. These are real stories from real people who have seen the impact of Heart Smarts in their lives. Are you ready to be the next success story? Your heart health is in your hands, and with Heart Smarts, you have the power to make a difference. It's time to take that first step towards a healthier lifestyle, a step that could redefine your future. Heart Smarts is not just an ally, it's a beacon, guiding you to make informed decisions for your heart health. So why wait? The path to a healthier heart is just a click away. You'll find the link to Heart Smarts right down in the description below. Start your journey towards a healthier heart today with Heart Smarts.
Have you ever wondered how to build wealth for the future? Well, one of the most effective ways to do so is through investing. Investing, in its simplest form, is the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. It's like planting seeds today so that you can reap the fruits tomorrow. There are various ways to invest your money, each offering its own balance of risk and reward. You could invest in stocks, becoming a part owner of a company and sharing in its success or failure. Alternatively, you could lend your money to governments or corporations by buying bonds. Or you might choose to spread your risk by investing in a mutual fund, which combines money from many investors to buy a diverse mix of stocks, bonds, or other assets. In the next few minutes, we'll take a closer look at these investment options and explore their pros and cons. So, stay tuned. Firstly, let's delve into the world of stocks. A stock is essentially a slice of a company that you can buy. When you purchase a stock, you are buying a piece of ownership in that company. This makes you a shareholder, and as a shareholder, you have the right to share in the company's profits. These profits are often paid out as dividends, which can provide a steady stream of income over time. But what makes stocks particularly enticing is the potential for capital gains. This is the increase in a stock's price over time. If you buy a stock at $10 per share and it rises to $15 per share, that's a 50% return on your investment. Not too shabby, right? However, it's not always smooth sailing in the stock market. Just as a stock's price can go up, it can also go down. This is where the risk comes in. A company might underperform, or there could be an economic downturn causing the stock's price to fall. If you sell your stock during this time, you could end up with less than what you initially invested. So, how do you navigate this? Well, one popular strategy is diversification. This means spreading your investments across different stocks in various sectors. That way, if one stock or sector takes a hit, your other investments can help cushion the blow. Another aspect to consider is your investment timeline. Stocks are generally suitable for long-term goals, as the market has historically trended upward over extended periods. So, if you're saving for a goal that's 20 or 30 years away, stocks might be a good option. Lastly, it's essential to remember that all investing involves some level of risk. The key is to find a balance that aligns with your financial goals and your tolerance for risk. Some people might be comfortable taking on more risk for the chance of higher returns, while others might prefer a safer path. While stocks can offer high returns, they also come with a level of risk. It's all about balancing your financial goals with your comfort level for risk. Now, let's shift our focus to bonds. Imagine lending your money to a friend, and they promise to pay you back in full, with a little extra as a thank you for your trust. That's essentially what a bond is. When you purchase a bond, you're lending your money to an entity, like a corporation or government. In return, they promise to pay back the principal amount on a specific maturity date. And to sweeten the deal, they'll also pay you interest periodically throughout the term. Bonds, as an investment option, are generally considered to be lower risk than stocks. Why is that, you ask? The answer lies in the structure of a bond. The interest payments, also known as the coupon rate, are fixed. This means that regardless of how the market fluctuates, you're guaranteed to receive these interest payments. Additionally, if the organization you've lent money to is unable to fulfill its promise, bondholders are typically paid before shareholders. This gives an extra layer of security to bond investments. But it's not all sunshine and rainbows. With lower risk comes lower potential returns. Unlike stocks, which can skyrocket in value, bonds offer a fixed return. You won't get any nasty surprises, but you also won't wake up to find your investment has doubled overnight. So who are bonds ideal for? If you're someone who prefers stability over uncertainty, bonds could be a good fit. They can provide a steady stream of income and are less likely to keep you up at night worrying about market volatility. However, the key to successful investing is diversification. This means spreading your money across different types of investments to balance risk and reward. While bonds may form a portion of your investment portfolio, they shouldn't be the entire story. Bonds can be a safer option than stocks, but they also have lower potential for returns. It's important to consider your financial goals and risk tolerance when choosing your investments. Next up, we're going to talk about mutual funds. These are investment vehicles that pool together money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Because they involve a wide array of securities, mutual funds offer a level of diversification that can be quite challenging to achieve if you were investing on your own. Consider this. You're at a potluck dinner. Instead of bringing just one dish, a mutual fund is like bringing a little bit of everything on the table. You get to sample a variety of flavors, and if one dish isn't to your liking, it doesn't ruin the entire meal. That's the beauty of diversification. Now, let's touch on risk and returns. Mutual funds can be seen as a middle ground. They typically offer higher returns than bonds, but come with less risk compared to individual stocks. This is because the risk is spread across a wide range of investments. If one company in the fund performs poorly, the impact on the overall investment is lessened by the performance of the other companies in the fund. However, it's important to remember that all investments come with some level of risk. Even though mutual funds are diversified, they can still lose value if the overall market declines. Hence, it's crucial to consider your risk tolerance and investment objectives before diving in. Another advantage of mutual funds is accessibility. Most mutual funds allow you to start investing with a relatively small amount of money. This makes them a popular choice for beginner investors who are just starting to build their portfolio. Lastly, it's worth noting that mutual funds are managed by professional fund managers. These are experts who make investment decisions based on thorough research and analysis. Mutual funds offer a way to diversify your investments. balancing risk and returns. But it's crucial to understand the fund's objectives before investing. So, take your time, do your research, and make sure the mutual fund aligns with your financial goals and risk tolerance. After all, investing is not just about making money, it's about making informed decisions that help build your wealth for the future. Now, why is it so important to start investing early? Well, imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing bigger and faster with each roll. That's the power of compounding at work. Compounding, in the context of investing, is when your earnings generate even more earnings. You receive interest not only on your original investments, but also on any interest, dividends, and capital gains that accumulate, so your money can grow faster and faster as the years go on. Starting early gives your investment more time to grow, just like that snowball. Each year's gains can generate their own gains the next year, a powerful wealth-building phenomenon known as the compounding of returns. Let's say you start investing a small sum every month at the age of 25, instead of waiting until you're 35. By the time you're 65, you could have twice as much money as if you'd started 10 years later. That's the power of starting early. But it's not just about the money. Starting early also gives you the luxury of time, which can be just as valuable. With more time, you have the flexibility to ride out the ups and downs of the market, making it less likely that you'll need to pull your money out at a bad time. It also allows you to take on a bit more risk in the early years, potentially reaping greater rewards in the long run. Moreover, starting early can help cultivate good financial habits. Regular investing, much like regular exercise, can lead to significant long-term benefits. It becomes a habit, a part of your life, and not just something you scramble to do at the last minute. So let's revisit our snowball one last time. The sooner you start it rolling, the bigger it can get, and the longer it can roll. That's why starting early in your investment journey is so crucial. Time can be an investor's best friend. The sooner you start investing, the more potential your money has to grow. So where does this leave us? We've journeyed through the basics of investing, understanding the unique appeals and potential pitfalls of different investment options. From the adrenaline-fueled world of stocks, where fortunes can be made or lost with a single decision, to the more stable and predictable realm of bonds, offering a safer, though perhaps less exciting, path to financial growth. We've also explored the middle ground of mutual funds, where diversity and professional management can help balance risk and reward. But the most important lesson, the golden nugget of wisdom, is the profound impact of starting early. Time is the most valuable asset in the world of investing. It allows for the magic of compounding to work its wonders, turning small, consistent investments into a substantial nest egg. Investing is not a get-rich-quick scheme. It requires patience, discipline, and informed decision-making, but the rewards are well worth it. Remember, the journey to building wealth starts with a single step. Make that step today and secure a better financial future.